The problem is that Credit Suisse, by some standards, might be too big to fail, but also too big to be saved.
This stock has been in a huge downfall for 2 years. So there are clearly problems within this particular institution.
We simply don't know the degree to which this is systemic or isolated.
As a global bank, there might be counterparty risks for some of the U.S. banks.
If one gets into trouble, people very quickly start looking, oh, what's the next one that looks remotely like this?
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
ECB President Christine Lagarde, over to you, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Equity futures down about 0.1%. If you are just tuning in this morning, welcome. Credit Suisse is up 24%. Overnight tapping the Swiss National Bank for 50 billion Swiss in liquidity, talking about repurchasing debt as well. This isn't the only name we're looking at this morning. Here's another one. First Republic in the pre-market, down around about 26% at the moment. At one point, down almost 40 percentage points only moments ago. Tom, this was a $120 stock only a week ago, and now it's trading in the 20s.
It's the way it's down, John. There's no technical analysis this morning on FRC in the pre-market. It is a plunge beginning 5:50 a.m. or so. We breached 20 moments ago, a little bit of a bounce now, but we need to see a bid here above that 17 handle, which was the low on Tuesday.
I've said it a few times already this morning with regards to this company. Very little news around it. We had a report here at Bloomberg that they are considering a sale after being downgraded to junk by S&P Global Ratings and Fitch Ratings just yesterday. I keep going back to the statement, the bare bones we have from the bank so far, Lisa, from Sunday evening, which is basically they said they had 70 billion in unused liquidity to fund operations from agreements with the Federal Reserve and JP Morgan.
The sentiment has a self-fulfilling prophecy, though. I mean, even the downgrades, it wasn't necessarily that they were downgraded to junk by S&P, by Fitch, but why? It's because sentiment is deteriorating and people could potentially withdraw some of those deposits. The customer base could deteriorate in the face of a potential loss in confidence. So given that, you are seeing in sympathy PacWest down about 5%, Western Alliance lower by almost 3%. Is this the beginning of yet another shoe? And this is the concern that people have.
OK, it's your turn. Get in the middle. Rock on a hard place. You're Christine Lagarde. You sat down. You've had your governing council meeting. The good and the great have all sat around the table and told them each other what they think of the situation and what they should do. Where do they come out on this one?
If I were Christine Lagarde, I'd totally punt. I would just say, you know what? We're going to come back in a week. Right now, we don't know exactly how this is all playing out. Our impression is that the financial market is completely stable, that the financial system is stable. We're going to provide every single facet to make sure that it is, and we still have an inflation problem. We want to raise 50 basis points. We just need to see it play out, and then they wait, and then they do that.
And this is the dynamic analysis we have, and this is like goosebumps, folks, going back 20 years here on Bloomberg Surveillance. To have Richard Clarida with us here, the vice chair, who is literally, as academics, is the dynamics of the economic system. They have Dominic Constam in a moment. And Devin Ryan in between with JMP to talk to us about the securities analysis of the moment. These are people that can deal with the ambiguities, the choices that people have to make.
Very cool. Let's get to those conversations in just a moment. Here's a flavour of the price action. For those just tuning in, your equity market is negative by about 0.1% on the S&P 500, even with a major move on Credit Suisse this morning. Moving to the upside. Looking at the Nasdaq positive yesterday, again today, up 0.2% in the bond market. The 2-year, the 10-year, the 30-year, the 2-year looks a little something like this. The 2-year, 3.99, up 10 basis points. Your 10-year, basically unchanged on the 10-year at 3.46. And a belief this morning, Lisa, I think a real belief that some people look to the ECB to give them some idea as to what the Fed's going to do. We heard it earlier this morning a few times already. I think it was Ian Lingen of BMO who suggested that if the ECB makes a move, then that's probably going to be the template for the Fed to do the same thing.
Is ECB now the central banker to the world? Can we say that yet? I don't know about that. All right. Meanwhile, this is what we're watching today. We're watching.
That dead, didn't you? Just cut that dead.
No, I don't think so. I think Jerome Powell's here, and I would like to see some visibility. I think it would be timely at an appropriate point in a prepared statement for him to provide confidence to the system, as Secretary Yellen did a number of days ago.
You want one of those statements that says we're watching things carefully and we think things are resilient. You want one of those?
You and I think it's stupid, but I think in the public in crisis it has value.
Okay.
Right now, we're not necessarily seeing the confidence build too much. What I'm watching this morning, among the different actions and activities, I'm watching European bank stocks, and they were up at one point as much as 2%. Now they're up only about 1%, 1.2%. So really, you've seen that move fade over the morning. After yesterday, we saw the biggest decline going back to March of 2020. Then, of course, at 9:15, this is a real key issue: ECB rate decision. What does Christine Lagarde do? The press conference at 9:45 a.m. How do you do no harm? I mean, we were talking about this earlier. Hard to know what that real option is, the least of worst options, Tom, as you put it. And at 10 a.m., U.S. Treasury Secretary Janet Yellen gets a turn. She's going to be testifying in front of the Senate Finance Committee. I don't understand exactly what she can say to give some sort of sense of confidence.
Maybe she'll say a note for Powell.
Yeah. I mean, really, does she give some guidance on what the central bank should do? It's going to be important and market moving, what she says.
If I'm Lagarde, I've got that statement in front of me, and I just read it verbatim and just keep returning to it and just keep returning to it. You just don't want to say the wrong thing.
I have laryngitis.
Yeah,
I'm sorry.
That's a good one too.
Continue.
Dominic Konstam does not have laryngitis. He's got to make a call. He's the head of macro strategy at Mizuho Americas. Dominic, let's start here. ECB first. How much daylight is there between what you think they should do and what you expect they will do?
Well, not too much. I mean, I think they are a little bit behind the Fed in terms of raising real rates and fighting inflation. So if I were to expect the Fed, for the sake of argument, to stop, and the ECB was expected to raise 50, it's pretty easy for them to just scale that back and sort of signal that they're almost done. But I would expect them to sort of still push rates a little bit higher.
In famous Konstam 2020 hindsight, Dominic, you absolutely nailed it. On this show a number of weeks ago, you pounded the table, a lonely table, saying they are super restrictive. As they go into these set of meetings, are they still super restrictive?
Yeah, I mean, financial conditions are actually tightening through all of this. The idea is, I don't know if you recall last year, there was this Fed paper talking around sort of R double star. That's, we won't know it until we see it. And I think the idea is that we're seeing it now, that rates have basically beginning to sort of break aspects of the financial system, particularly in the US, which is a different situation than, say, Europe. Yeah, I mean, absolutely super restrictive. I think it's part of the speed with which rates have gone up. So you can sort of maybe revisit these levels in a more calmer tone. But the fact is, if you want to fight inflation, you better sort out your financial system first. You can't fight inflation and solve the financial system at the same time by raising rates.
Dominic, we're expecting to hear from Janet Yellen later this morning that everything is fine in the financial system, that we have real resilience. What would it say, from your vantage point, to risk markets if the Fed comes out and says, you know what, we were wrong, inflation isn't the preeminent concern, and even though everything is stable, we're not going to raise rates anymore? Don't you think that could potentially be a liability for some of the riskier assets?
Well, the issue for the financial system, in a sense, if you say it's fine from a capital perspective, that's largely true. But obviously, it's from a liquidity perspective that you've got the issue, and we saw it in the gilt market last year, whereby liquidity problems can become solvency problems for, in that example, the insurance sector, and that's what you're seeing in the medium-sized banks. So. It is true. You can say, financial system is fine, but you've got to focus on liquidity, and on that basis, you have to kind of when the liquidity problems coming from the so-called risk-free rate. And the Treasury yield curve that's attached to that, then that's your problem. So you can't basically fight inflation. And I agree that does maybe give people a cause for concern around the credibility around inflation. But the other thing that we've been arguing for a while is that this inflation is sticky and it's almost beyond the control of the Fed. There's a time element with which inflation will come down that the Fed can't necessarily control.
Dominic Konstam, you invented the linkage of quantitative finance into economics at Credit Suisse with Neil Sass years ago. You do have experience at Credit Suisse, to say the least. Can you imagine UBS merging with the Credit Suisse Oh,
absolutely, yes. I mean, that's I think that's the I don't think, what the Swiss National Bank has done is obviously extremely important, a massive liquidity facility. There are a lot of idiosyncratic problems, obviously, at Credit Suisse. It's kind of fairly intuitive that in the long run or the medium term, some sort of resolution would involve the Swiss banks finding some kind of tie-up. Good bank, bad bank, whatever you want to call it. The main thing about Credit Suisse is they have a wonderful private bank, and that's what they kind of want to preserve. An investment bank is, it is what it is.
Would that private bank be valuable to other UK, continental, or American banks? I mean, there's a mystery here to the new culture of Credit Suisse. Do you denote a new culture?
Yeah, I'm not a bank analyst, but I would say the private bank has always been the sort of jewel in the crown, and it's been very impressive, and I would absolutely imagine it would be attractive to a lot of people. Yes.
I think we're all bank analysts this week. Dominic, thank you.
Foxhole.
Dominic Constant, thank you, sir, of Mizuho. Lisa, you've talked about this all morning. We're going to hear from Secretary Yellen today in front of the Senate Finance Committee. We've got some text of her prepared remarks, and here's the quote. "I can reassure the members of the committee that our banking system remains sound and that Americans can feel confident that their deposits will be there when they need them. This week's actions demonstrate our resolute commitment to ensure, Lisa, that depositors' savings remain safe."
So herein lies the question for Jerome Powell. If this is true, then does this mean that they have the option of pausing or even signaling rate cuts in the near future if the financial system is sound? I mean, can there be a sort of nuanced argument made about the tightening in financial conditions in the heels of this that accelerate the process, that don't necessitate them raising rates? Or will that send a message that could potentially be really problematic?
There's another point here, and it's not been made official, but it's implied by the actions of Sunday and this quote here. "The resolute commitment to depositors, all depositors, above what is still meant to be the FDIC limit of 250,000, right? Is that gone now? Are we guaranteeing all deposits in America?
And at what cost, right? I mean, this is the issue that people have been talking about. Are they going to charge a premium for insuring deposits above $250,000? Are we seeing a fast-moving policy before our eyes that they're basically coming up with in real time, and they're going to figure out the details later?
Feels that way.
Are all banks in the same pool, or is there still a distinction of small banking in America?
That's an important question, Tom, that I don't have the answer to. Looking at First Republic, down 27% in the pre-market. Looking at Credit Suisse, up 23%, and those two names dominating the conversation so far this morning. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. The Pentagon released video showing a Russian aircraft intercepting a U.S. Air Force surveillance drone in international airspace over the Black Sea. The Pentagon says the Russian Su-27 approached the back of the MQ-9 drone and released fuel as it passed. The military says it discarded the drone in the sea after the Russian fighter jet poured fuel on the unmanned aerial vehicle and then struck its propeller. The chairman of the U.S. Joint Chiefs of Staff, Mark Milley, says he doesn't know if the event was intentional, but he says the Pentagon video suggests Russia's actions were aggressive. Defense Secretary Lloyd Austin and his Russian counterpart, Sergei Shoigu, spoke yesterday in what appeared to be an effort to reduce tensions. The European Union will provide a clearer legal framework to target family members of sanctioned Russian billionaires. It's an important shift after the EU court annulled penalties imposed on the mother of a close ally of President Vladimir Putin. The European External Action Service, the bloc's foreign service arm in charge of listings, told member states it will submit legislation soon. In London, commuters are facing disruption for a second straight day as rail workers strike across the country. Services into the capital will be restricted as workers across 18 companies represented by the RMT union walk out over a pay dispute. Yesterday, about 500,000 British workers staged a mass walkout, time to disrupt Chancellor's Exchequer Jeremy Hunt's annual budget speech. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
If anything will happen to Credit Suisse will be of systemic effect for not just the European financial system, but also for the global financial system. So if Silicon Valley Bank create ripple effects in global financial market, something bad happening to Credit Suisse will be an order of magnitude more severe, something more like a Lehman moment.
That was a brilliant Nuria Rabini of Rabini Macro Associates, the chairman and CEO. A better morning for Credit Suisse so far, at least. Good morning to you. The stock is up by 22%. A statement of confidence from the regulator and the Swiss National Bank yesterday afternoon. And then overnight, 1:45 a.m. Zurich time, they tapped the S&P for 50 billion Swiss and intend to buy back some debt as well. So far, so good. Better, certainly better than what we saw yesterday, but still in and around 2 Swiss francs per share on the stock. That's not the only stock we're looking at this morning. First Republic, another one. It's down 30% in the pre-market, downgraded to junk from S&P Global Ratings, Fitch as well. All of that yesterday. Our reporting yesterday evening is that they might be mulling a sale. That stock is down 30% in the pre-market. It was 120-something a week ago. It's in the 20s now, wow. So that's a big turnaround in the last week or so. Janet Yellen, Elise has talked about this all morning. The Treasury Secretary is going to go in front of the Senate Finance Committee a little bit later on this morning. What was that, 10 a.m.?
10 a.m.
Eastern time. So
what's the date
looking
calendar?
Forward to
Lagarde's
that.
in the 9, not the 8. We have the decision when? 9:15?
9:15 Eastern is ECB.
When is Lagarde's?
45 is when the news conference starts.
And then Yellen
so
in 15 minutes.
you're going to have 2 screens. You're going to have Yellen, and then you're going to have Lagarde at the same time. Personally, I'll be watching President Lagarde. We've got a flavour of what we'll hear from Yellen.
I agree.
Already, the Treasury Secretary putting out some text of her prepared remarks. Here's the quote. Let's get that quote up again for you if you are just tuning in. This is what Treasury Secretary Janet Yellen had to say. I can assure the members of the committee that our banking system remains sound and that Americans can feel confident their deposits will be there when they need them. She went on to say, this week's actions demonstrate our resolute commitment to ensure that depositors' savings remain safe. Now, a question that Lisa and I were exploring about 10 minutes ago, Tom, is whether there is just an implied guarantee for all depositors now in the whole banking system across the whole of this country.
I don't hear anybody talking against that. I mean, the fact is, is that a given?
Feels that way. Haven't made it official. They're certainly implying it, though, with language like that this morning.
We're going to have to see. Dominic Constant with us here, of course, formerly with Credit Suisse and now with Mizuho, was just wonderful. The former vice chairman of the Fed, Richard Clarida, will join us. In between them is a tour de force of smaller bank analysis. Devin Ryan was iconic at Sandler O'Neill years ago, as we talked to Thomas Shode of Keefe Bruyette a few days ago. Now with JMP Securities, Devin Ryan joins us this morning. Devin, I'm going to cut to the chase. In your South Bend, Indiana, there is First State Bank, and on their website, they have hometown values since 1910. Are we going to end up where all banks are treated the same, that First State Bank of South Bend is treated the same way as JP Morgan of Park Avenue?
Hey, good morning, Tom. I don't think we're necessarily going that far. I think there needs to be small banks and regional banks, and the regulators don't want to see all market share go to the top 4 or 5 companies in space. So I think that there will be a balance, but I think the big question in the market right now we're talking to our clients about is what is next? What type of regulations do come? I think there's an expectation that there will be change coming out of this that could add expenses for most banks, that could change asset liability mix, and then people are going to be conservative on the other side of this as well. And so those are, I think, a lot of questions in the market. But what the Fed and FDIC did, I think, was necessary and really kind of, I think, stopped a more systemic, bank run. And so we feel good about that. But we do think that kind of now the questions are what comes next year for the system.
Devin, do you think that guarantee to depositors, regardless of size, do you think that's implied now?
Yeah, I think effectively it is. And if it isn't, then it potentially would be if things got worse from here. But I think that what the Fed and FDIC did was enough to kind of, I think, assure depositors that their money's safe. And really, bank runs are a confidence thing. And so we saw what happened with Silicon Valley and some of the reactions since then. In our opinion, what's happening is now we're kind of moving to an earnings story, and interest rates are moving lower. Credit is now kind of front and center, and money did move around late last week, and so some of the banks that are in the press potentially, money did move around, and businesses are going to be more conservative around what banks they're putting their cash in. And so I think all those factors are playing in to the sentiment right now.
Devin, different banks, different problems. What would be the distinction that you drew between, say, SVB, First Republic, and then Credit Suisse, which just feels like a different beast altogether? What's the big distinction for you?
Yeah, well, I think the big distinction is, first off, Silicon Valley, I think a first-year banking analyst can understand their balance sheet, very simple, and you understand where the issues were created. Credit Suisse is a much more complicated, entangled financial institution. I think that's where kind of there's more fear, with CDS blowing out yesterday. It's just how complicated this bank is and how intertangled they are to financial markets. And so, I don't cover them, so I don't have a strong view there, but I appreciate where kind of that's a separate dynamic. And that's a little bit more for my seat around kind of credit concerns. SVB was kind of a duration mismatch and pretty simple in terms of what the issue was there. So I think that's a couple of the big differences.
That said, Silicon Valley Bank has put a spotlight on the credit profile of a number of smaller and regional banks. And Torsten Slok over at Apollo just put out a chart of some of the exposures and the differentials between big banks and the smaller ones. There is much more exposure to consumer credit, to bank loans, to commercial real estate at some of the smaller banks than at the large institutions. How much is this becoming a credit concern in an era of tighter financial conditions and higher rates?
Yeah, Lisa, it's a great question. I mean, I think that's exactly what this is becoming, whether it's deserved or not. I mean, the banks have been managing through thus far incredibly well. The balance sheet dynamics that we're talking about, even at Silicon Valley and other banks, are things that, as analysts, we look at and have been talking about for the better part of the last year or so. A lot of this is not new news, but it is front and center. I think there's, obviously increasing concern around economic conditions and, the tighter backdrop, and so what that could mean for credit. I think this comes down to, as it always is, risk management, asset liability management, and good banks are going to come through this. And actually, good banks take advantage of these moments and gain market share, gain depositors. And I think that's where the barbell is here, that, companies that didn't manage well are going to be penalized, and companies that did, when the dust settles, will come out of this in a good spot on the other side.
Devin, how analogous is this moment to the S&L crisis that we saw back in the 80s?
Yeah, I think, every crisis is different and feels different, but there's always, I think, some of the similarities and just the sense of fragility right now. And just when you have an announcement like what occurred over the weekend, that's destabilizing to markets. And so ultimately, that brings risk profiles in. People are going to be, I think, more conservative in the very near term. And, just investors that we talk to, people generally move to the sidelines when, there's headlines every day, every morning, trying to keep up with it's exhausting. And also, in a lot of cases, doesn't directly have anything to do with maybe a stock in their portfolio. And so it's a really challenging time. But as I said, we feel good. I think what the Fed and FDIC did very quickly was important to stabilize the broader system. And now you can start to focus on individual names. And Lisa, to your question, where credit risks do they lie? What are the effects of, kind of lower interest rates here to the extent that's the direction we're going? And so, there's a lot of factors here, but good firms will come out of this in a good spot.
Hey, Devin, thanks for being with us. Devin Ryan there of JMP Securities. Thank you, buddy. Looking at First Republic down about 27.6%. We'll turn top of that story for you. That's the story in the pre-market, at least for that single name. Tom, we said this a little bit earlier this morning. If these issues had developed several decades ago, this would have led to a major crisis almost immediately, because policymakers wouldn't have had the whereabouts, wouldn't have had the tools, wouldn't have had the experience, wouldn't have had the speed that they reacted to this in the last week.
I strongly agree with that. They have the much better macroprudential tools now, and the speed thing. Well, we learned a little bit about Twitter over the weekend.
Oh wow! Didn't we just? Tension simmer. It's a slow grind this morning, that's for sure. The ECB decision a few hours away. There are just no quiet mornings anymore, are there?
No.
They just don't exist. Good morning to you. Equity futures down about 1/3% on the S&P 500. Credit Suisse up 21%. It's doing okay. Still in and around 2 though, isn't it? got absolutely hammered yesterday. We saw the statement of confidence, if you will, if you want to describe it that way, from the Swiss regulator, the Swiss National Bank. Then the follow-through from Credit Suisse overnight, tapping the S&B for 50 billion Swiss of liquidity, pledging to repurchase some debt as well. So the stock's doing all right for now. Equity futures, as I say, still lower, though, down by about 1/3% on the S&P, on the Nasdaq up 0.1%. 9:15 Eastern time for an ECB decision. 9:45 is when you get the news conference with President Lagarde as well. So all of that good stuff is about an hour and 45 away. And the bond market going into it, 2s, 10s and 30s, look a little something like this. The 2-year up 8 basis points, 397. Lisa, the 2-year, and that's what a quiet morning looks like for the 2-year relative to what we've seen. The storm of the last week in the bond market has just been unbelievable.
It's unbelievable how much we've retraced the potential for rate hikes, and not just that, but pricing and rate cuts of nearly 100 basis points over the next 12 months.
Well, that's a 110 basis point move in the last 6 days.
So let's see what the next couple of days. When you said,
nuts,
every morning doesn't seem like a quiet morning. Are we in 2025 yet? It feels like every day is a year. Let's take a look at some of the other banks that are moving. You talk about Credit Suisse. You talk about First Republic in California. And this is the contagion of the moment where people start to look around and say, who is next? PacWest, which has seen a lot of volatility in those shares, down another 14%, I should say. It's moving as we speak and deepening with the losses of First Republic. Western Alliance down more than 11%. First Republic, we're tracing some of the lows of the morning, but down 25%. I mean, really, it just keeps bleeding. And Comerica down about 3%. We've been talking all morning about the banking system because that really is where the focus is. That has the most and potential to disrupt monetary policy. I do just want to flick at this because overnight we did hear CFIUS, the Committee on Foreign Investments in the U.S., recommend that TikTok's parent company sell their stake in the video sharing app or face a possible ban. Snap shares just ripping. Snap shares up more than 7% on the heels of this.
Who?
A ban from being used in the United States.
By people, my kids.
Correct.
Oh, very
So
cool.
it would either, don't get too excited. They're thinking about potentially selling it. But either way, Meta shares up about 2%, and you can see Snap shares up about 7%.
We welcome all of you on radio and television right now. Extended coverage by Bloomberg Surveillance today of this crisis at hand across the Atlantic and here in America as well. We're thrilled to bring you now for this entire half hour Richard Clarida, to say that he's a former vice chairman of the Federal Reserve System. His work at PIMCO also misses his work at Columbia University as Dean of Economics and his academic work on the oddities of dynamic stochastic general equilibrium theory. Right now, that doesn't matter. Dr. Clarida, thank you so much for joining us this morning. DSG is out the window along with the theories now. At any central bank, and particularly at Chairman Powell's central bank, does bank supervision take strong precedence before monetary theory?
Well, Tom, you certainly need strong bank supervision in all seasons. And I think clearly this episode indicates that there's more to do on that front. Chair Powell has indicated that that they're going to be looking at this. And I think the broader situation, ideally, monetary policy can focus on inflation and unemployment, and supervision and regulation can focus on financial stability. But there are occasions when the two are very tightly related, and that's certainly where we are today.
To be delicate about it, and I know is outside the public sphere now, maybe you don't want to comment, but John insists you do. Is this a point where central banks, including Christine Lagarde in Frankfurt, they need to pause?
Well, it's certainly a live option. Oftentimes the schedule works out so that the ECB moves the day after the Fed. This spring, they're moving a week before. And I do think all eyes on the ECB, because if Lagarde and her committee do decide to pause, I think that has some potential implications for the Fed next week. I think it would make a pause by the Fed more likely.
I categorize you and Adam Posen of the Peterson Institute, along with Michael Berta at Humboldt University, as our experts on Germany. You've done a great academic work on Germany over the years. How does the Bundesbank respond to this crisis? I mean, Nagel has all that heritage of Axel Weber and the rest. Richard Clarida, are we going to see in 1 hour the Bundesbank reign supreme and say, no, we stay on track to fight 7, 8, 9% inflation?
Well, Tom, it's not just the Bundesbank now. You know, the overshoot in inflation in the Eurozone happened after the U.S., but on a core basis, it's comparable. So my sense right now, and of course we'll know soon enough, my sense right now is that they do go ahead and hike at this meeting, because I think the challenges of managing a pause are not easy when you're pausing when inflation is well above the desired level. You know, if we were 10 years ago and we had this disruption in banking, I think all central banks would be happy to do an extended pause, but they have to really be concerned about their inflation credibility. So I think that will be a relevant consideration.
Richard, part of the conversation, and good morning to you, and thanks for being with us. Part of the conversation over the last week has essentially been there is a risk of not doing something too, that maybe you can spook the market just as much by not moving when you had intended to hike 50 basis points. You've confronted delicate moments like that in the past. Is that something that goes through your mind as a policymaker?
You know, John, it's a great question, because we confronted that in almost exactly 3 years ago today, in March of 2020. We cut rates before the scheduled meeting, and then we did so again on that Sunday, March 15th. And in both cases, the initial market reaction was, what the heck do they know that we don't know? It turned out to be a negative for risk sentiment. I can't speak for my former colleagues, but certainly if I were there, that would be on my mind, especially since the inflation numbers that we got this week show you that, if anything, the inflation prints are moving in the wrong direction.
That said, Rich, and this is really one of the conundrums for a lot of people, there is a fundamental tightening that is occurring at a rapid pace when you look at some of the smaller and regional banks, considering how big a role they play in corporate credit, in commercial real estate, in the broader credit complex beyond institutional loans. Is that enough to accelerate some of the disinflationary force that the Fed is looking for?
You know, we think so. We're looking into that a lot right now. An important driver of the business cycle is the credit impulse. You know, until recently, the talk in markets has been the Fed's not getting any traction from these rate hikes. And we're now seeing that traction. The inverted yield curve and the situation of many financial intermediaries means the Fed is getting traction. I think if this persists, and I expect it will, what it does mean is we may begin to see the disinflation kick in sooner than otherwise. And if we start to see that, the Fed probably will take that into account.
Does that mean 100 basis points of rate cuts, I should say, in the next 12 months?
The short answer is too soon to tell, because up until now, the mantra coming from the Fed is they need to keep them there for an extended period. But again, this is a fluid situation. And if you do see a real cutback in lending, that will begin to show up pretty promptly. And in particular, Lisa, if inflation does start to come down durably, then that'll be a factor. Whether or not it's 100 basis points, I won't get into the exact pricing right now.
Well, Richard, I love leaning on your experience of all of this, because, as you know, this Fed has to put together the projection materials. They've got to put together an SEP in this environment. Richard, how on earth do they do that?
Well, the short answer is, with great effort, and oftentimes the SEC projections are pretty straightforward. John, in March, I hate to keep coming back to that, but it is recent and it's not relevant today. In March of 2020, and I'm not saying there's an exact or even close parallel, there's some parallel. In March of 2020, we actually just didn't release projections at the March of 2020 meeting just because of the huge uncertainty. Right now, I don't think they will take that step. Again, that could be interpreted adversely. What do they know that we don't know? The projections are finally balanced. As you know, if you count the dots, it would only take two participants from the December meeting to move up to actually have the dots shift up by 25 basis points. It'd take a lot of folks to move down to get the dots to shift down. So yes, as we were saying on these things, this is a very high stakes meeting for the Fed next week.
Richard Clarida, out on Twitter, there's a sport saying we got to look at 14 years of QE and really ask, was this a successful experience? Let's take it to the wonderful David Folkerts-Landau at Deutsche Bank. Professor Clarida, was the negative interest rate model a successful experiment?
You mean negative interest rates as we saw in the Eurozone, Switzerland, and
yes,
in
Europe,
yes.
in Japan, in the United, somewhat in the United States.
Look, I haven't followed that situation at the Fed. We chose not to go negative. My observation across two oceans is that negative rates were pretty complicated to implement and explain. I'll leave that up to those officials if it was worth it. But yeah, we didn't go down that road in the U.S.
I wish he could come back.
He is coming back next. Another segment with Richard Clarida, the former Fed Vice Chair, sticking with us, and currently Tom of PIMCO, and much more.
I think of the late Marvin Goodfriend and the arguments of Adam Posen of Peterson Institute with Marvin Goodfriend about the efficacy of negative rates, the courage to go negative rates. And what so many people said is you can go sort of kind of like negative interest rates. And Folkert Landau said, if you're not going big time to clear the system, it's not going to work. And in hindsight, you really wonder if you sort of kind of like economics sometimes doesn't work.
Well, negative rates feels like a lifetime ago. They've got to confront the decision right in front of them. And I think we've got a really interesting snapshot there into the psychology of a policymaker sitting on a central bank who do worry about the signal they send if they don't hike. Do you inspire confidence if you do? And there's always been this sense that central banks might know something we don't, which I've always found is quite ludicrous, but it exists, and people feel that way. They think that way when you get these decisions, Lisa.
That's the reason why. And I thought that was fascinating, that Rich Clarida thinks that they will go 50, that potentially that means that the Federal Reserve will follow with at least a 25 basis point rate hike, even at a time when there is a fundamental tightening in financial conditions that's going on under the surface.
Okay, let's amend. If they do that or something like that, they've got to double barrel it, as Professor Clarida said at the top, with financial supervision and with that guidance along with it.
If you believe it's idiosyncratic and you believe it's contained, you focus on monetary policy, you look at inflation data, and you hike interest rates. It's that simple. If you're worried it's not, and you don't think it is, then you pause. And it's the signal you send from that pause that ultimately might worry some people. The real question we've got to ask, and I keep asking it, can you really isolate what's happening in the banking system over the last week from the monetary policy decision today if you believe that what's happened in banking over the last week will lead to tighter lending conditions?
As Neil Dutta put it, why is this being treated like a bug as opposed to, say, a feature of what they have been trying to do?
Precisely. Equity futures right now on the S&P down 0.2. Credit Suisse higher by 21%.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Chancellor Olaf Scholz says that Germany will have to do a better job at preventing, quote, irregular migration and deporting people who live in the country illegally. Scholz says Germany will continue to provide protection for the more than 1 million Ukrainians who have fled the country following the Russian invasion. Meanwhile, some 200,000 people from Syria, Afghanistan, and Turkey applied for asylum in 2022. Poland's defense minister says the country is in talks with Slovakia on transferring Soviet-era fighter jets to Ukraine. Earlier this week, Poland's premier said that a delivery could take place in the next 4 to 6 weeks. It's a move that would cross a threshold among NATO member states that have drawn the line at offering Kyiv air power. Credit Suisse surged the most on record after tapping the Swiss National Bank for a $54 billion loan and offering to repurchase $3.2 billion worth of debt. Meanwhile, Credit Suisse's top shareholder says panic around the bank financial stocks is unwarranted. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Really what's happening here is the market is conducting a stress test on the Fed. The Federal Reserve and other central banks, I think at this stage, should stop hiking and provide real reassurance that they are going to protect the financial system and deal with this problem. I think that's really what they need to focus on.
That's what they are focusing on right now. That was David Kelly, the Chief Global Strategist at JP Morgan Asset Management. Equity futures at the moment just about negative, down 0.1% on the S&P 500. No real drama here. going into that ECB decision, 1 hour and about 30 minutes away. Futures on the Nasdaq positive by 0.33%. In the bond market, 2s, 10s, 30s shaping up as follows. The 2-year yield, which is where all the fireworks have been over the last week, up 5 basis points this morning, still south of 4, 393.83. And just a quick sneak peek of what's developing over at Credit Suisse. Credit Suisse is positive by 21% after tapping the Swiss National Bank for 50 billion Swiss. And First Republic, a big name that we're watching over here on this side of the Atlantic. First Republic, Tom, down about 24.5%.
A little churning here. They're both waiting for news, but very different news. And you wonder what the timeline is on that. I wonder, does the SNB or anyone there did they get out front of the ECB? I just can't imagine that.
With what? A monetary policy decision? Oh, I've got no idea. No idea.
I just can't fathom. No, just something about Credit Suisse. How do you get in the way of the ECB with Credit Suisse crisis stuff? You've got to wait till the press conference.
Well, with the stock up 20% or so, I'm not sure what they can add at the moment.
Yeah, well, it's better.
Mission accomplished?
They hope.
No, I don't think we're anywhere near mission accomplished. What we're going to do is continue here with a former vice chairman of the Federal Reserve System. Richard Clarett is with us, global economic advisor at PIMCO and student of his economic history. Professor Clarett, as somebody spoke of creative destruction this morning, and that reminded me of a guy named Hyman Minsky, who long ago and far away had Schumpeter as his doctoral advisor. And of course, Hyman Minsky in the lore talks about a Minsky moment, or maybe talks about the efficacy of regulation. Let's bring over the cacophony of another time and Hyman Minsky over to what Michael Barr at the Fed needs to do. What is the best outcome of the new bank regulation and the lessons we're learning in this March?
Well, I think that there's been a lot of progress, Dodd-Frank, and in particular for the large, systemically important institutions with stress testing and liquidity and all the rest. I think what this episode does reveal is that institutions may look small, they can get big. As you know, SVB, for example, tripled in size in a couple of years, and even institutions of that size, as we saw over the weekend, can be systemic. So I think the clear direction of travel is going to be that under existing statutes and laws, the Fed has enormous flexibility in the way that it supervises institutions on a case-by-case basis. And I think we're going to see that level of supervision, in particular scrutiny of things like the hold to maturity portfolios being underwater and liquidity and the uninsured deposits are all going to be factors in. So the direction of travel is going to be tighter supervision. Yeah.
Would you suggest our central bank will have to adapt to the political realities of Republicans hugely distrustful of the big accumulation of capital, almost in a Jacksonian way? How big will that umbrella extend out from the too big to fails?
I think it's going to certainly extend into a number of the names that are in that 100 to 250. I remind you that was actually by statute in 2018. The statute said that less prudential scrutiny for banks under 250 billion. But again, the legislation gives the Fed a lot of autonomy within that on an individual bank basis, and we're going to see that, I think, with tighter supervision.
What we just saw, though, a lot of people are pointing the finger at the Federal Reserve and saying that they should have had more supervision of this bank and that this was a policy failure that has really interfered now with their ability to raise rates elsewhere. Do you think that that's fair? Do you think that this was a policy mistake, or do you think that this is a direct result of rolling back that aspect of Dodd-Frank in 2018?
Well, I've looked into it a little bit. Again, I'm no longer in that building or talking to those folks. The interesting thing, Lisa, is that the stress tests that were set up very successfully after Dodd-Frank typically looked at scenarios with deep recessions, high unemployment, and falling interest rates. And SVP would have done great in that scenario. They didn't have a lot of direct exposure in lending or the like. But what they did have, obviously, is a lot of exposure in long duration treasuries and mortgages. In particular, there's something called a global market shock that looks into that. I've also seen some work that indicates, again, I can't judge, but that SVP would have passed the standard Fed liquidity test. So clearly, I think they're going to be studying this. I don't want to prejudge where they end up, but I think that is going to be reviewed and changed.
That said, Rich, and this is a point that Neil Dutta made, and he's going to be on later in the show. He said, the Fed basically has hiked a lot. Why are they surprised by duration risk? And why is it being treated as a bug rather than a feature of the hiking program? From your vantage point, do you think that perhaps there has been a bit of complacency about the resilience of an economy that so far hasn't broken, but now is starting to show some more acute strains?
I don't think I'd use the term complacency. What I would say is I broadly agree with Neil in the direction of travel. Look, when you raise rates, you invert the yield curve on a sustained basis. That is intended to tighten financial and credit conditions, and it is tightening financial and credit conditions. And so I hope nobody in the building thought that we could get to this point without there being a tightening in lending. Now, importantly, and let me get this on the table, what the Fed did Sunday night was exactly the right move. It's essentially expanding the discount window authority to lend against good collateral, which has been in place since 1913. And that's an entirely appropriate thing for the Fed to do, to give institutions liquidity against their security portfolio. So I think that was right. But yes, I'm broadly in that camp that when you raise rates and you invert the curve, you're going to make lending more expensive, and intermediaries are going to bear some of that burden. Absolutely.
How much more likely is a hard landing, in your view, a recession that does inflict some more pain today than, say, a week ago?
It's certainly more likely. I've been in the camp consistently, I think, since doing your show last fall, that we more likely than not, we will see a recession with a rise in unemployment and some negative prints on GDP. Again, when you have a rate hike cycle of this magnitude, and how quickly, that is going to be the outcome. But yeah, have the odds of a hard landing gone up? They certainly have. I don't think that's my baseline for a hard landing, but sure, the odds have to have gone up somewhat.
Richard, I just want to finish on this line that you often hear when central banks don't do something you expected them to do, and you hear things like, they might know something we don't know. Does the Fed ever know something we don't know?
Well, look, the short answer is yes, not often, and not to a great degree. I tell you, one situation where we didn't know anything that people didn't know was about the coronavirus, and so we didn't have any special briefings or insight.
What about banking troubles, Richard? If there were banking troubles behind the scenes, are they things that the Fed would know about but wouldn't talk about?
Sure. Well, yes, because the Fed has supervisors on the ground with thousands of banks at a very granular level, and so certainly some of that information is not in the public domain, and appropriately so.
That's why things become so speculative, Tom. In the next week going into this decision, it's so difficult for this Fed chair.
Should we have Clared on tomorrow? Can we get him on for another? I
think he's joining us every day. You're out next week. What you don't know is that Richard Clarida is going to be...
He's guest hosting
He's
for
going
me?
to be guest anchoring
that's good.
next week. Richard, thank you, sir, for being with us. What an important morning. Richard Clarida there, the former Fed chair, Fed vice chair, and currently of PIMCO.
What I didn't get to is this idea of level versus rate of change, in that we can all state, and clearly the vice chairman made clear, he feels the level of getting up to defeat inflation is important, but the speed to get to that level, my guess, will be the history study of the next 24 months.
12 months, 0 to 450. That's fast.
I did it on fancy log paper, and the answer is it was fast, fast, fast.
Happy anniversary. It's 12 months today from the first hike.
I did not know that.
Are we celebrating? Not really, no.
No.
Okay, no one's celebrating. Okay, all right. That's enough of that. I thought that was why Rich was up. The anniversary of the first hike, yeah.
Oh, yeah.
Happy days.
That's called a Tang Mimosa, is what you used to celebrate.
Classy.
Yeah, it's classy. Thank you.
The Federal Reserve and other central banks, I think at this stage, should stop hiking and provide real reassurance that they are going to protect the financial system.
The ECB has to acknowledge that they've got to ring fence things.
I would assume the Federal Reserve would probably do something like hike rates in March and then go into a pause, see where the dust settles.
They've got to kind of stay the course, in my humble opinion. And I think to do anything else would really be a misstep.
I tell you who I do not want to be in the next week is Jerome Powell. Boy, the Fed is in a very massive pickle here right now.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on television amid a banking crisis. Stability for those watching Credit Suisse. Stability on FRC in America. And, John, all the people watching that, their stability is to count on Christine Lagarde in the next hour.
Yeah, when stable is down 27%, Tom, that kind of speaks to the story of the moment.
It speaks to the tension of the moment.
First Republic. I don't want to be Christine Lagarde. I'm not sure anyone wants to be Christine Lagarde this morning. The ECB president first out the gate to address this with a monetary policy decision. 9:15 Eastern time. They were set to go 50. Will they backtrack? And how does that set the tone? Not just for today's price action, but for the Fed next week too.
If you're just joining us on radio and television, what is distinctive here, our team working on this coverage all night. And John, where I've changed now versus 2, 3, 4, 5 hours ago is a raging debate of what ECB and Fed will do between a 0.5 percentage point rise, a moderate 1/4 point rise, or pause. I don't know.
I don't know either. We got some great insight from Richard Clarida about 20 minutes ago, the former Fed vice chair, on the risks of doing what you said you would do and the risks of not doing it at all. And the signal associated with the latter may be a little bit more than the former. If you don't make a move after committing to making a move, what kind of signal do you send? And that is something that is on the mind of policymakers, Tom, when they make these calls.
In crisis, a single signal, I got that out, a single signal is the bond market. Lisa Abramowicz is steeped in this. What has been the nuance of the bond market, Lisa, in the last number of hours?
It depends which bond market you're talking about. When you take a look at credit markets, you have seen a pretty wide spread widening. In other words, a bigger risk premium being baked in. When you take a look at the rates market, we've talked about the incredible volatility. A lot of people pointing to short-term yield curves that point to, and I'm talking about the 3-month versus the 2-year. It inverted the most over the past couple of days, going back to 2001. And after an inversion of that kind of level back in 2001, the Federal Reserve came out with an emergency, unexpected 50 basis point rate cut. So that basically signals that short-term, very short-term rates are substantially higher than they will be in just a couple months' time.
John, what's the institutional response? You mentioned, I say Chair Yellen, surveillance correction. Secretary Yellen had a statement here in the last hour.
Yeah, she did. She's going to go in front of the Senate Finance Committee at 10 a.m. Eastern time, so 2 hours from now. Lisa's been pointing us towards that all morning, and I think it is important to hear from the Treasury Secretary. Her words here, Tom. This week's actions demonstrate our resolute commitment to ensure that depositors' savings remain safe. Everyone we speak to right now believe, although it's not official, that there is an implied pledge from authorities in America to back up all deposits regardless of size.
Our team and our economics team, led by Scott Lamb, will follow this. John, let's go through the date calendar because it's confused by daylight savings time in America. We're in the 8 o'clock hour for those of you worldwide here on Wall Street. This is when we see ECB know. John, the festivities begin in the 9 o'clock hour.
9:15, the decision. 9:45, the news conference. Somewhere in between, we're set to get some forecasts too. Good luck to them as they put together those forecasts, Tom. I've got no idea what it's going to look like next week, next month, never mind year end and beyond.
My data item is NYMEX crude to 65. Yesterday, a spike down 67.80 on American oil. Maybe a signal of dampening disinflation and economic slowdown.
Yeah, and on the supply side, I think it was the IEA that came out yesterday, which feels like a long time ago, but I think it was yesterday morning, right? They came out and they talked about a market surplus for crude because of Russian supply. So that's another factor in there too.
Let's dive into the hour, and we do this with George Bory. We've had a really wonderful cross-section of guests here this morning, and what George Bory brings to us, Chief Investment Strategist at Allspring Global, is what are they doing out there? On an institutional basis, George Bory, what is the level of panic, and is it basically endless phone calls, go to cash?
Yeah, no, thanks, Tom, and good morning, everyone. Thank you for having me on the show. What our clients are doing are really twofold. First and foremost, they're sort of looking at their liquidity positions. They want to know, what does my portfolio look like? How well are we set up? Are we well diversified? And what kind of liquidity do we have in our portfolios? And for that, we're able to answer very definitively kind of what they can do and how much maneuverability do they have. The second question that clients are asking is from a positioning standpoint, do they have enough duration? What we've been reminded over the last week or so is that duration matters, and in times of stress, having sort of that longer duration position can be very, very beneficial, particularly in a fixed income portfolio. And so, as we kind of work our way through this, sort of making sure that our portfolios have, enough income to be able to meet the obligations of what our clients are trying to do. Do they have enough liquidity to be maneuverable in this kind of market, which quite frankly is difficult because, as we know, liquidity is challenged in the fixed income market. And then just lastly, do they have that insulation? Do they have that insurance policy kind of built into the portfolio, which is that anchor of duration? Lisa just talked about the front end of curve and Fed expectations. Those are shifting rapidly, very rapidly. We went from, expecting 100 basis points of rate hikes to 100 basis points of rate cuts, over the next 12 months. Radical change in outlook. Companies and investors need to be able to position for that, and that's precisely what we're doing for them day in and day out.
Well, talk to me about how easy it is to manoeuvre at the moment. These moves we're seeing in the depth of the Treasury market, never mind securities people hardly trade. The two-year yield, Thursday down 20, Friday down 28, Monday down 61, Tuesday up, then bang, Wednesday down 36. George, how easy is it to get in and out of the Treasury market at the moment?
Liquidity is thin, John, and we know it's been challenged. And so, sort of from a size standpoint, you can move risk. It depends on how big your portfolios are and how much risk you need to move. So from our perspective, we have been able to access the amount of liquidity that we need, particularly in the Treasury market. But when we look at it in the aggregate, it's clear liquidity is challenged. So we need to be very precise about our decisions. And we also have to have at least a little bit of kind of a forward-looking view on the assumption that the trade that we do today, we may have to sit with for at least a few days, but hopefully even longer than that, to sort of get our portfolios on the right side. Liquidity is challenged, but it's not impossible.
That's in the deepest, most liquid market in the world. How about the less liquid markets of credit? And I wonder, given the spread widening that we've seen, the sort of increased risk premium baked into high yield bonds, whether it's enough. Do you view these levels currently of more than 5 percentage points over benchmark rates as sufficient to offset the sudden surge in default risk in credit events?
Yeah, no, Lisa, that's a great question. And when you sort of look at credit markets, when we look at risk premiums just in spread terms, that would tell us that things are getting stressed, but we're not pricing in recessions just yet. And that's something that we are kind of looking at. Policy, from a stimulative standpoint or a restrictive standpoint, is passing through an inflection point in the cycle. That's clearly what's happening over the past week. We're going from a one-dimensional kind of fight against inflation to a two-dimensional fight against both inflation and liquidity within the financial system. That has repercussions for the real economy, not just the banking system. The real economy is going to experience tighter credit conditions going forward. And if we use sort of high yield spreads, call it at 5.25%, 5.5%, that looks sort of attractive, but it's not pricing in a recession. That is the risk as we go forward. So it is a little premature to say, sort of a hard landing's priced in and now is the time to buy. We're not there yet from a valuation perspective. However, I would say when we look at yields, all in yields, you are looking at sort of levels that look fairly compelling. So it's this sort of battle between yields and spreads. Spreads tell us we still have a ways to go. Yields look reasonably attractive.
Just quickly here, George, to understand the reaction function by markets to the Fed, to the ECB, would you go more pro-risk or less pro-risk if the central banks continued with the rate hiking that they had planned?
I think regardless, Lisa, at this point, we're going less risk. And the reality is the other side of this sort of bout of volatility and policy intervention should be slower growth. The central bank's in a tough spot. We think they will raise rates, but they're also sort of fighting a liquidity problem in the financial system. Even though they're using sort of liquidity to fight that battle, the cumulative effect of tighter credit conditions is going to persist. It is probably going to get worse, not better, over the coming kind of weeks and months. On the backside of that is slower growth. And so from a credit perspective, we want to be sort of up in quality. We are up in quality. Yep. We are going to remain up in quality.
George, got to leave it there. Smart. George Borey there of Allspring on what's happening in fixed income, just the ease of getting in and out of the market and some of the risks we face at the moment. That last piece, almost verbatim, exactly what we heard from Bob Michael at JP Morgan Asset Management on the fixed income side yesterday. Just this idea that tighter lending standards are coming. Economic growth is going to get choked off just a little bit more. I asked the question earlier, what does the Fed know that we don't know? And I think on the economy, as we've seen repeatedly, maybe not very much. But when it comes to financial risk, something that the former Vice Chair Richard Clarida talked about 10 minutes ago, been having a private conversation to the side as that interview was ongoing, somewhat smarter than me, basically saying the same thing, that when it comes to the financial system, perhaps they know things that we don't know.
Yes.
So it raises an important question for the central bank decision today and next week too. And it goes back to a theme we've been probing over the last couple of days.
Can we stay?
If they don't hike, what is the signal that they send?
Exactly.
And that's something they've got to manage.
Well, that's the risk, no question about that. Maybe the data will help. Does this data matter in 20 minutes?
What data?
Data, exactly.
We haven't gotten any in a week.
Can I editorialize here right now?
Please.
That's a great question in our extended surveillance this morning. Here's the score. That's a great question. Bramo 4, Ferro 1, and I got the goose egg.
Yeah, not exactly unexpected.
That's a great question.
I think doesn't Bramo get
Lisa,
that every single morning?
that's a great question.
Every single time.
Who's keeping
McKee
track?
never gets this. That's a great question.
You are. You've got like a little his scorecard
I get like
there.
0.
TK's got the chalk out.
You know.
It's like...
making that noise.
Yeah,
you get 5 and we get to go.
Brutal. No, stop. Future's negative 1/10 of 1%. This is Bloomberg.
Didn't know we were keeping score. Keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. Well, the Pentagon released video footage showing a Russian jet dumping fuel on a U.S. surveillance drone in international airspace and apparently clipping the aircraft, challenging Moscow's contention that it had no role in Tuesday's downing. The chairman of the U.S. Joint Chiefs of Staff, Mark Milley, says the U.S. does not seek an armed conflict with Russia in the wake of the spy drone incident. Defense Secretary Lloyd Austin and his Russian counterpart, Sergei Shoigu, spoke yesterday in what appeared to be an effort to reduce tensions. Treasury Secretary Janet Yellen plans to tell Congress today that the U.S. banking system remains sound. She's looking to reassure lawmakers, depositors, and investors before taking what are likely to be tough questions about how the sector is regulated. The hearing comes amid tumult in global markets and worries over financial stability after the rapid-fire collapse of 3 regional U.S. banks and troubles at Credit Suisse. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
All eyes on the ECB, because if Lagarde and her committee do decide to pause, I think that has some potential implications for the Fed next week. I think it would make a pause by the Fed more likely. My sense right now is that they do go ahead and hike at this meeting, because I think the challenges of managing a pause are not easy when you're pausing when inflation is well above the desired level.
Brilliant to hear from Richard Clarida there, the former Fed Vice Chair and currently the Global Economic Advisor at PIMCO. Citi echoing that view. Citi just moments ago, Andrew Hollenhorst publishing. Tom, the ECB following through with a larger sized hike this morning. Citi expects 50 basis points. We'll have some read through to the Fed hiking 25 basis points potentially, Tom, next week?
An historic morning here, and of course, for those of you in America used to the early morning ECB with daylight savings time, it's shifting. Michael McKee joining us right now, our chief economics correspondent, all things international, and Maria Tadeo in front of the lawn that young John Ferro used to be in front of years ago. John, what is an ECB meeting like? I mean, what's the body language?
They transitioned buildings in my time there as well, Tom. Because that's a new big concrete building with some wonderful art inside.
I'm going to be direct. Other than McKee and 3 or 4 other people, I get a lot more out of the ECB press conference terse questioning.
Well, I think Draghi encouraged that just in the way that he ran the news conference. There was some back and forth. There were some follow-ups. There were 2 questions. I was always entertained by it.
In banking crises, does Maria Tadeo's lunch get cut back from 3 hours to 2 hours?
If you can find somewhere to actually eat in Frankfurt.
Yeah, okay.
Yeah,
just want to
that's
be
usually
sure.
how it goes.
Why don't you bring her in?
Maria, 9:15 Eastern Time, so about 1 hour from now. 50 basis points was the pre-commitment. That's what we all thought. Does it change?
Yeah, by the way, before we get to that, when you say young Ferro, it doesn't mean you're not young anymore.
Thank you.
It's another important question that Tom brought up. But when it comes, it's an important point to clarify there. I mean, what is the threshold of young Ferro? But beyond that, look, Jonathan, I think when you're an ECB reporter, obviously you spend a lot of time, you talk to people, you try to get a sense of where consensus is. And over the past 24 hours, it has been all over the place. I've talked to people who have really told me this has got to be 50 basis points. This is what was baked in. The data absolutely justifies this, and the European Central Bank should look through the market volatility that we've seen. Then obviously on the flip side on the spectrum here, those that say 25 basis points, it is worth considering, would say when you look at the forecast and the path forward and the medium to long term, yes, that is great, but the issue is in the now. It's in the moment. So for me, there's 3 things that I want to watch out for. Obviously 50, 25. Beyond that, I want to see how much consensus there was behind that decision, and then it comes down to the communications. We've had a lot of people comment on this, running commentary, finance ministers, politicians, market players, but ultimately this comes down to Christine Lagarde. This is her job. Whatever happens, she needs to defend this decision confidently and instill this confidence in the market.
Maria, we've been talking all morning about what do central bankers know that we don't know. And with the Federal Reserve, there is this financial supervision arm that gives them a lot of insight into the health of the financial world. How analogous is that for the ECB, especially in a disparate Europe with different regulatory bodies, and also Switzerland, which isn't part of the EU and not under their oversight?
Well, it's not, because it's a Swiss bank, essentially. And when you look at what the French Prime Minister said yesterday, is that this was a problem that is for the Swiss to deal with. The issue is, of course, we know that the banking world is very connected and European banks are also exposed to it. And that's why yesterday you had many reports suggesting the European Central Bank was already sounding out to European banks to figure out what kind of exposure they have to Credit Suisse. Now, it is important to stress we've not had a lot of communication on this from the ECB for 3 very simple reasons. One is, of course, they do not comment on specific stock moves. Then secondly, the timing of this is complicated because, you know, it's a quiet period. And then yesterday, deliberations were going on. Decision is today. But this is a question that is going to come up repeatedly in this press conference. She is going to be hammered on about the stability of the European financial system. And again, a lot of this will be about the communications. Can she really instill that confidence that the market wants to see?
With us in New York, Michael McKee, before we come up on economic data in America. Mike, you do have a huge global perspective here as well. With the data dependency, and this is data dependency now in crisis, how is 830 treated differently because we're in crisis? How is the data of Europe treated differently because they're in crisis with Credit Suisse?
Well, the problem is, Tom, what the data are backward looking. And so what we're going to get today at 8:30 and what we're getting in Europe this week is not going to have anything that really relates to the idea of a banking crisis affecting economic growth. You had Rich Clarida on, and he said it should show up relatively soon as credit tightens, but it won't have shown up yet. So in that sense, both the ECB and the Fed are flying a bit blind. There have been a number of houses out there who have put out analysis of what the credit tightening might mean for economies, but they're also working with the old models. We don't really know if things are going to unfold as they did pre-pandemic.
But the sum here, are economies slowing? I mean, just as a general statement, a lot of people are saying financial crisis, disinflation, financial crisis, deflation, West Texas Intermediate all of a sudden under 70. Can you say, a la Empire, tertiary, that there is indications of economic slowdown?
There are a few, and it depends on what countries you're talking about, which is also an ECB issue. Is they're dealing with all the different countries. I have to pass on Portugal at the moment, but I could look that up. But I tell you what the issue is we are expecting a lot of things because this is what's happened in the past. But yesterday, and this got totally overlooked by everybody, the Atlanta Fed came out with its latest GDP Now survey for the United States for the first quarter. 3.15, 3.2%.
Wow, I did not know that.
So if you're thinking that tighter credit will take some demand out of the economy, the Fed is going to be cheering for that. It's just really a question of how far it goes. I think what we have done is move in the banking issue now from whether the banks will survive, because the central banks have moved quickly to underpin them, and there may be one or two in the U.S. that go down, but the big ones are going to be fine. So the question is, what are their interconnections, the ones that are in trouble? Maria mentioned that, the ECB surveying, the Fed surveying. If there's counterparty risk out there, then you get back into the 2008 kind of issue. If there's not, then it's probably not going to be as bad as people think.
And Maria, just to give you the last word, the interconnectedness not only of the financial markets but also of central banking policy. Is there any indication of how close the interconnectedness is of Jay Powell and Christine Lagarde?
Well, when you look at everything that Christine Lagarde has said, especially in the run-up to big global decisions like this, is that there has got to be a level of coordination, and this is now a global conversation. And again, going into this press conference, the statement really matters, but I presume that will also come up. Is there going to be a much bigger change now on the global scale? And just to clarify, I did not have a 3-hour lunch. I had a 30-minute lunch. What I did do, however, spend 2 hours yesterday watching Real Madrid win on the Champions League, because there are some good news in Europe at times, too.
There we go. She's got to squeeze that in.
No 3-hour lunch.
It's
Real Madrid supporters.
I mean,
hey? We haven't done sport all morning.
Well, you know,
cover the
it's
ECB.
You know,
got to squeeze in some Real
when we
Madrid.
go to Jeddah this weekend for Formula One, I mean, Maria's, she's getting into Formula One.
Can I just say,
too.
30-minute lunch is today's 3-hour lunch, because everybody in the U.S. sits and eats at their desks. I'm just saying.
I remember when there were many restaurants with white linen and silver, and one by one, in America, they just disappeared.
Well, you guys are important. You get lunch. Some of us don't.
We get
Portugal,
lunch.
Tom.
We get lunch at 10 a.m. Eastern
Portugal.
time.
I looked it up.
Please,
I looked it up. Forecast is for 0.9% growth in 2023. Last year was 6.8%, so that is quite a drop.
Let's be clear about what time lunch is for us, Mike. It's like 10 o'clock, something like that.
We're an hour and a half away.
John,
breakfast food.
The breakfast this morning, and they served it on Royal Dalton. I thought that was just such a nice touch.
Nice.
Very posh.
At 3:30, I missed that one.
Posh.
Maria,
Posh
thank you.
Bloomberg.
Mike McKee, thanks to you as well, sir. Some data. Mike's going to stick with us to go through that in a moment. In the next hour, Alessio De Longis of Invesco is going to join us to go through the ECB decision. Ella Hodger of Pictet, looking forward to that. You're going to hear from Jay Pawlowski at TPW as well. Jay was very constructive on the European banking story. Very, very constructive on the European banking story. Is he still constructive on that story? Has the facts changed, Tom? Has his views changed?
I really want to hear there from Mr. De Longis. I think he's got wonderful second-size nation perspective in the ECB. We don't talk enough about that.
We are about 50 minutes away from an ECB rate decision. Equity futures on the S&P totally unchanged.
Bloomberg Surveillance, a very long Bloomberg Surveillance today. Thank you to our team for early morning hours here amid this bank crisis. As a summary, Credit Suisse is stabilized. off the bottom yesterday with some big percentage moves coming back from the opening peak, but Credit Suisse stabilizing this morning, and also FRC, First Republic, is stabilized at a lower level than what we saw yesterday. We'll continue to follow that. Right now, rudely getting in the way before Lagarde in the next hour is American economic data. Wow. And once again, this is the time where claims, they're going to reverse. We're going to get back to a less employed America, right, Michael McKee?
I'm sorry, Tom, you're wrong. Not this week. 192,000 for initial jobless claims. We're staying in the same range. There was a feeling that last week's 211 was overstating the numbers because you got some people who were off work in New York schools and they could file for claims, and that appears to be the case. We've fallen back from 211 to 192, and continuing claims fall. 1,684,000 from 1,718,000. Housing is dead. The housing market is obviously affected by these high mortgage rates. Housing starts increased 9.8% after a revised drop of 2% in January. And the deal with that was it was originally reported as negative 4.5%. Building permits up 13.8%. There seems to be some confidence in what's going on. I know Lisa is like totally freaking out. Let me just quickly say, Lisa, Philadelphia Fed,
the Bramo cam showed you that.
Philadelphia Fed negative 23.2, a slight improvement from negative 24.3, but that still tells you that there's a concern about manufacturing in that Philadelphia district.
This is where data dependency goes to die, because in another time we would have looked at this and said, resilience in the economy, let's go. Hiking very much on the table. How far do you want to go? And right now we're seeing almost nothing in the 2-year, really very little movement across the board. Markets are not responding to this data. So at what point have we just killed off data dependency, which was the prime clarion call of every central banker out there?
Well, it's not so much data dependency in a broad sense, but it's data dependency of a couple of indicators, which would be inflation and the jobs numbers, and both of those still suggesting strength in the economy, which falls into that, what we were talking about, the Atlanta GDP. But the jobless claims are supposed to be something of a long-term canary in the coal mine. They don't deal with jobs created, but they suggest if companies are starting to get nervous, and apparently they are not starting to get nervous now. Labor hoarding is still underway. The one you can't figure out is housing. I mean, obviously, that is weird. We did see over the last couple of days, home builder stocks rising a lot on this idea that the Fed might be cutting interest rates later on. So mortgage rates have actually dropped a little bit. And if that trend continues, you could see why there'd be some strength. But that's a lot to bet on. And of course, all these were done before any of this banking stuff.
Quickly, we got to get the data here, the optimist. But Mike, dovetail this with your comment that I missed yesterday on Atlanta Fed's effort, folks, to really be on top of where gross domestic product is right now. I'm sorry, it's almost a boom number, right?
Well, it is a boom number. This is, as of yesterday, 3.2% for the first quarter. It has a little more validity than when we were talking about it back in January, because now we've got January and we're starting to get some February numbers. It'll change as we go through February and we go through this month, get the February numbers. You get into March and you'll get some idea of what it really is. But so far, the first part of 2023 has held up very well. And so that's something, again, the Fed is, like everybody else, looking at what has happened in the past. And I'm not sure what that tells us about what's going to happen in the future.
Take a break, Mike. Michael McKee with us here, trying to deal with the dependency. And your data check was brought to you by Lisa Abramowicz. Look for Lisa Abramowicz to be clear and say,
at your local pharmacy.
None of it really matters. I mean, what do you do with a 2-year yield up 6 basis points, higher yield 3.94%, when you've got Credit Suisse churning, First Republic Bank churning here, Credit Suisse lifting off the trauma of yesterday, First Republic coming down from a trauma yesterday, Yellen to speak later.
Okay, so you're seeing no adjustment in Fed funds rates and the expectations here going forward. This, to me, is the conundrum. We had data dependency. We said that we were going to get these really important reports, a labor market report last Friday, then Tuesday CPI was going to shatter the world, change everything. And then no one cares. And that, to me, is the conundrum for central bankers. How do they either make them care or give in to the new narrative that might shift again by next week?
I think they're going to look asymmetrically, and they're going to say, if we make decision A, what does it mean on an asymmetric basis, B and C as well? And to give us clarity on that, not only in the United States, but in Europe, that's surprised a lot of people with optimism, is Neil Dutta. He's head of U.S. economic research at Renaissance Macro, and he has absolutely nailed the resilient American economic experiment over the last number of quarters. Neil, wonderful to have you with us and try to get away from talking about banking crisis. Just in all of your study of economics at NYU, Neil Dutta, is it just simple? The ECB will ignore the data and the ECB will be on plan as scheduled?
I don't know. That's an open question. My own sense is that they probably don't go 50. I mean, remember, wasn't it Lagarde that was picking up the phone and telling Hank how terrible of a decision it was for him to let Lehman go under? So, in my view,
again, we'll see that in the next.
That she's probably going to err on the side of caution here,
and we'll see that again in the next hour here with daylight savings time in America. And I've never heard Dutta talk about ECB, so that's pretty cool. That's what a crisis will do to you.
This is a moment where we're all experts in random things that just seem to pop up from day to day, and that's sort of the question that I have for you: is how do you even chart a path forward when the facts change this quickly, and they are material because this leads to an actual tightening in credit conditions and lending?
Yeah, I mean, that's true. I mean, the question is part of the reason why the economy was so resilient, remember, was that it wasn't especially credit sensitive to begin with, right? That's one of the reasons why, the folks talking about long and variable lags for the last 18 months, then shifted to talking about the weather, then shifted to talking about seasonal adjustment issues, and now are saying, oh, look, the lags finally kicked in. Sometimes in this business, Lisa, it's better to be lucky than good.
Well, and this raises this issue of how do we even know what our biggest challenge, what our biggest threat is? And I go back to what Nouriel Roubini was saying, which is if the Fed pauses, if the ECB pauses, this could allow an unmooring of inflation expectations at a time when you do have an economy with strength. What is your concern about that? Is that still a preeminent risk, or will the tightening take care of itself?
No, absolutely. I think it's a risk. I mean, I don't think what's happened right now in the banking system, as unnerving as it may be, is enough to really, send the U.S. economy into a below potential growth state. I mean, remember, as the data make clear, we went into this with a lot of momentum, right? You're talking about Atlanta Fed tracking 3.5%, and you're talking about inflation running 5%. So you're talking about an 9% nominal growth environment. That helps grease the wheels a little bit. So, even though the data is stale, let's try to remember that the momentum going into all this is pretty robust. And that gives us a bit of a shock absorber once this goes on. At the same time, the inflation data are not encouraging. I mean, people looking at PPI and saying, oh, this is a reason for them to back off. I mean, it's absolutely ridiculous. Core inflation is running hot. Inflation has been so strong over the first 2 months of the year that if it didn't do anything for the rest of the year, it'd still be up 1%. So, I think the risk is if they pause, they may have to come in later, and then they may have to be even more aggressive. So I tend to sympathize with that view.
Neil, give me a level here. One of my great themes is Europe just flat out does not have a nominal GDP persistency like America. We are generally, because of technology and maybe a different demographic and economy, set at a higher level. If I'm right on that, what's your run rate on nominal GDP?
I think we're in a 5 to 6% underlying nominal growth environment right now. You talk about 2.5% real growth, around 4% inflation. So, 6%, I think, is a reasonable benchmark.
And that seems to me to be pretty constructive as well. Can they pause, ECB today or a Fed here in a number of days, can they pause with a strong statement that they will resume rate hikes as appropriate at some point?
I mean, they could do that, but I mean, my sense was in reading the events of last weekend and what the Fed has done, my assessment is it goes back to the Bernanke discussion about using the right tools for the right job. What they did was try to ring fence the banking system to create the space for themselves to keep hiking, to deal with slowing down the economy, and underlying demand. Remember, rates are a blunt tool that affects all industries at the same time, right? Not just the banking sector. So I thought in some ways you can make the argument that what they did over the weekend was a way to create the space to ultimately hike. At the margin, obviously it makes 50 basis points less likely. You can't talk about a systemic risk exception and still go 50. But I think you can make a reasonable argument to keep going 25. The data remain quite strong. And we're not at a point yet that suggests significant economic damage as a result of this. As Michael McKee mentioned, I mean, home building stocks have been doing well. Housing can't work if credit isn't flowing to households.
Neil, just quickly here, has a chance of a very hard landing or a harder landing become more likely in the past week as we've seen some of the tensions come to the fore?
Yes, it has, because I think the biggest risk of a hard landing is if the Fed follows the market's pricing of interest rates. Because the markets, the fixed income market has an implicit dovish bias. And if the Fed follows that, it risks entrenching inflation, which further will push the Fed away from where the markets are, and that will risk a much harder adjustment later.
Neil Dutta, thank you so much for the Renaissance Macro Research this morning. We need to get back to the two stocks that we've been following all morning. Credit Suisse, I'm going to say, the word I'd use in technical analysis is a soup. I just really don't have much to talk about here other than a stability at 2.05. First Republic, Lisa, just simply has moments ago broken down under a 22 level, 21.30 is a larger move of 31% down for the day. We will continue our coverage here through the morning on radio, on television, a huge calendar coming up. Christine Lagarde in the ECB in Frankfurt and Secretary Yellen after that. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In London, a lot going on. Services into the capital will be restricted. We have commuters facing disruption for a second straight day. Rail workers strike across the country. Now, those services into the capital will be restricted as workers across 18 companies represented by the RMT union walk out over a pay dispute. Yesterday, about 500,000 British workers staged a mass walkout, time to disrupt Chancellor of the Exchequer Jeremy Hunt's annual budget speech. Moving on this morning, Credit Suisse surged the most on record after tapping the Swiss National Bank for a $54 billion loan and offering to repurchase $3.2 billion worth of debt. Meanwhile, Credit Suisse's top shareholder says panic around the bank's financial stocks is unwarranted. Poland's defense minister says the country is in talks with Slovakia on transferring Soviet-era fighter jets to Ukraine. Earlier this week, Poland's premier said that a delivery could take place in the next 4 to 6 weeks. It's a move that would cross a threshold among NATO member states that have drawn the line at offering Kyiv air power. And Chancellor Olaf Scholz says that Germany will have to do a better job at preventing, quote, irregular migration and deporting people who live in the country illegally. Scholz says Germany will continue to provide protection for the more than 1 million Ukrainians who have fled to the country following the Russian invasion. Meanwhile, some 200,000 people from Syria, Afghanistan, and Turkey applied for asylum in 2022. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I think if institutions don't focus on their inflation mandate, they will be making a very serious mistake. And if they appear to be abandoning concern about inflation, they will make a very serious mistake.
Secretary of Treasury of the United States, another time and place ago, Lawrence Summer. He is a former Treasury Secretary there in a moment of fast events. And as we approach the ECB meeting, important headlines out now from Spain and Mr. de Guindos. These are really, really market-moving headlines. A market moved immediately off this. The ECB has told ministers, and this a day ago, I'm going to make this 2 days ago, that some banks, quote, could be vulnerable. I looked immediately at euro, which is a 106, and we're down to a 105.93 level. I'd also point out the German 2-year is trying to discover the low yield of yesterday now. The German 2-year is down as well. Lisa, you've been looking at EU bank reaction.
Yeah, well, I just want to elaborate a little bit more on these comments that that Luis de Guindos told the regular ECOFIN ministers in Brussels, that lenders in that region are much less exposed than their counterparts in the United States. But at the same time, he said the ECB couldn't rule out that some lenders might be at risk because of their business models, and he cautioned not to be complacent. The market is taking a look at this. You could see BNP up about 0.7%, SocGen shares down a little bit lower, 1.3%, and Credit Suisse maintaining the gains, although still struggling to stay above €2 per share, 2.05. Here's the question. The read-through in markets, I would say, Tom, really is that people are using this as perhaps the tea leaves for the reasoning of why the ECB would opt to move only 25 basis points rather than 50 basis points, with a weaker euro, with a sharp leg lower in the German 2-year yield, and a sympathetic move over in the U.S. if the Federal Reserve is taking cues from ECB's Christine Lagarde.
Do you think we can say that the body of guests that we've talked to over the last 12 hours look for them to be steeled and to raise rates, and yet others are heated, don't do that, a gaffe?
The only consensus that I've gotten over the past 4 hours is that people expect there to be some read-through from whatever Christine Lagarde does to what the Federal Reserve does. This idea that the Fed will follow in suit and will either not hike rates or hike rates 25 basis points if the ECB goes either 25 basis points or 50 basis points, depending.
On vulnerability like this from the ECB, the first thing we do is look at the markets, and Chris Turner is quite good at this as Global Head of Markets Research at ING Bank and joins us at this moment. Which data point do you study, Chris, in the cacophony of a half hour to get to an ECB decision? Do you fall back on the Germany 2-year, or is there some other secret Chris Turner data point?
No, I think like a lot of people, we look at a whole variety of indicators. I think looking at the short end of the European bond market is very good, as you say. What we have been looking at as well over the last few days is things like the cross-currency basis swap at the short end of the curve for any signs of stress in money markets. There has been a little stress earlier this week, although that has improved today. But as you and your guests have been talking about, a very difficult decision for the ECB coming up very shortly.
What is the sum of ING? Do they do, Peter Garvey, your economist, do you suggest that ECB will pause?
No, I think the core view from Carsten Brzezinski, our chief economist for the Eurozone in Germany, is that the ECB would very much like to push ahead with 50 basis points today. So that's our official call. And yeah, we just have to see if that does come to pass. In the context of obviously sticky inflation, but also looking forward as well. They'll be cutting their inflation forecasts. I think the market will be looking to see whether they cut their growth forecast as well, which might hold out an olive branch to the Dubs for the rest of the year when it comes to the ECB policy curve.
Chris, how much has your outlook for growth as well as for rate hikes changed over the past week?
Yeah, I think bigger picture, we are negative on the dollar for the second half of the year. And in a way, you could argue that the sort of stress in financial markets and the banking sector we've seen over the last week or so bring forwards the point when the Fed will ease. The market's now pricing maybe 100 basis points of Fed easing in the second half of the year. Up until last week, we thought that it would be just a Q4, like a modest kind of easing cycle. So that has brought that forward. But I think we do need market conditions to settle first. I think while they're unsettled, while we've got these incredibly high levels of volatility, particularly in the interest rates markets. I think FX markets won't settle into the looking for carry, looking for value. I think it's all about safety in the short term, and I think the markets, as I say, will wait for conditions to settle before returning to those macro stories.
On the micro side, a lot of people were taking a look at European banks earlier this year and saying that was the place to be. They were undervalued. Is this a story that you can get more involved with, considering the sell-off, considering the discounts we're seeing? Or is it the opposite? Have we seen risks unearthed that people hadn't imagined earlier in the year?
No, I think the market would just, as it has been doing over the last week, be sort of assimilating all the new news that comes in from an investment perspective, looking what it means on a relative basis in FX markets for US versus Europe. And obviously the story is sort of very mixed at the moment, but what we have seen so far today is a slight improvement of conditions. And yeah, we'll be looking at, I'm sure, many plans that were kind of set up over the last sort of month or so. They're being sort of like reassessed. But I think, you know, the macro probably will come back to dominate in the second half of the year.
Radio and television this morning, we're awaiting the ECB decision in the next hour due to daylight savings time. And then we'll move on to comments by Secretary of Treasury Janet Yellen in the following hour, I believe. With us right now, Chris Turner of ING on foreign exchange. Is there a trade to be made here, Chris Turner, or do you just simply have to step aside?
Well, what the market has done clearly this week in the foreign exchange market is buy the yen. And you can see why, really. We haven't had this kind of stress in financial markets for quite a while. You know, obviously equities corrected and bond markets corrected 20% last year without really sort of pressure in the financial markets. So, and the yen didn't play that role as a safe haven last year because it was like a macro slowdown and because of the energy crisis as well, which really dented the yen's and Japan's external position through, you know, higher energy prices, fossil fuel prices. But now, what we're seeing in a way with this pressure in the market over the last week is that global rates are now converging towards Japan. And I think investors are returning to the traditional benefits of the yen, which are the large current account surplus and the large net foreign asset position. So I think
Interesting.
The market will hold on to the yen for the time being.
That's fantastic because we've almost completely ignored Asia over the last 48, even 72 hours. Chris Turner, thank you so much. With ING Bank today, red and green on the screen, the VIX from a 28 level into 26.85 right now. Lisa, if I can sum up everything here, all I can fall back on is Michael Rosenberg's Bloomberg Financial Conditions Index, which has gone from this new restrictive -1 standard deviation to a little more accommodative in the ether, if you will, a little more accommodative where I would suggest maybe a tilt within the market towards 25 basis point or a pause versus what was bandied about 4 fun-filled days ago.
This just feels like a soup. I mean, trying to make sense of anything and trying to, I mean, honestly,
mathematically elegant word.
It's a very elegant soup. I'm looking at the, you know, what the parameters of potential binary outcomes here are.
Well, there you go.
And there's so many different ones, and it's very difficult to know what the central bankers should do. But as a trader, how do you even respond if you knew the outcome? Would you know the market's response to it? In this case, I would say no, time and again.
With our Maria Tadeo in Frankfurt, folks, and for those of you in America, this is of import to your investments in America. And what I would suggest, whatever the decision is, she will hedge it immediately. If it's 50, she's going to hedge the other way. And if it's pause or 25, she's going to hedge to the Bundesbank vigilance, which we know is there.
And on the other side, the data that we were supposed to be tracking, the facts that we're supposed to navigate, that we were supposed to give us some sort of compass, are showing strength, which is exactly the opposite of what central banks are looking for in terms of trying to make progress in the disinflationary fight, which they're hoping for. So how do you put this soup together with a narrative that has any consistency?
The way you put this soup together, which is Bloomberg Surveillance Extended today, is you have a team. Our team, thank God for the interns. You know, we had like 37 people, and with the 5 interns we've got, it's really, it's really come together here in crisis. We say thank you to our team for particularly just wonderful guests. Dominic Constam there, and of course the former vice chairman of the Fed, Richard Clarett, as well. We continue strong into this morning, into this crisis on radio and television. Stay with us. Good morning.